Good morning, everybody. Welcome to the Advanced Ichimoku Trading Strategies webinar. Today is August 5, Saturday. This is the first of two parts of our Advanced Ichimoku Trading Strategies webinar. Now let's talk about what we will be discussing today. Course description. Advanced Ichimoku Trading Strategies webinar is made for Ichimoku users who would like to harness the full power of Ichimoku. It discusses and applies the basic Ichimoku trading system along with other strategies for higher probability of success. At the end of the course, the student will be able to apply effective tools along with Ichimoku to increase trading efficiency. You will learn the Ichimoku trading system, its components, and the effective utilization of tools for more profitable trades. Course outline. Part 1, Ichimoku Kinko-Hayo Review. Lesson 1, Review of Ichimoku Kinko-Hayo. Lesson 2, The Signals. Part 2, Trend Following and Ichimoku. Lesson 1, Moving Averages. Lesson 2, Heikin Ashi Candlesticks. Lesson 3, Fibonacci Retracements. Part 3, Breakouts and Ichimoku. Lesson 1, Kumo Breakouts and Darvas Boxes. Lesson 2, Setting Profit Targets. Lesson 3, Chart Patterns. So let's go to our Part 1, Ichimoku Kinko-Hayo Review. Lesson 1, Review. Ichimoku Kinko-Hayo is a one-glance equilibrium chart. It is a visual trading system that allows traders to identify the trend and to look for potential signals within the trend. It identifies support and resistance, determines the direction of the trend, and provides trading signals for entry and exit. Ichimoku is best used for trending markets. The signals provide entry and exit levels that commence a trend. This chart of MEG shows an uptrend, and it occurs once all bullish Ichimoku signals are present. You would find in the first part of the chart, Ichimoku elements are above the Kumo after it gave a change in trend from a downtrend to an uptrend. And then we find a Kumo twist on top, and the trend changed from an uptrend to a downtrend. In this case, Ichimoku elements are all below the Kumo. Then we find a change in trend once again. Ichimoku elements are above the Kumo, and we find another uptrend. Lesson 2, The Signals. So what are the signals that tell us whether a security is going to go on an uptrend? So here are the conditions of an uptrend. Remember that we discussed this previously in our first basic Ichimoku webinar. The first is when price crosses above the Kijun Sen. The second is when the Tenkan Sen crosses above the Kijun Sen. The third is when the Chikou span crosses above the price. The fourth is when there's a Kumo twist when the Senkou A is above the Senkou B. The fifth is when the price breaks above the Kumo. So you find an entry level once the last condition was met, which is the breakout above the Kumo. So this is your entry level. This results in an uptrend. We find a strong trend, and your support levels are the Tenkan-sen and the Kijun-sen lines. Now, what are the bearish signals? These are the conditions for a downtrend. First, the price crosses below the Kijun-sen. Second, the Tenkan-sen crosses below the Kijun-sen. Third, the Chikou span crosses below the price. Fourth, the Kumo makes a twist from a bullish Kumo to a bearish Kumo, wherein the Senkou span A is below the Senkou span B. Fifth, price breaks below the Kumo. Now, once all these conditions are met, the result is a downtrend, and the Tenkan-sen and the Kijun-sen become the new resistance levels. Now, Ichimoku should not be used for ranging markets. Now, this illustrates why Ichimoku should not be used in a sideways market. This is the chart for LC. We find that the prices are consolidating inside the box. The Chikou span had been moving in and out of price ranges, therefore it did not have a definite breakout. For example, in this area, in number 1, we see that the Tenkan-sen and the Kijun-sen had been crossing above and below each other, therefore the signals are conflicting. In this area, the Chikou span broke above the price but failed to stay above it. In this area, the Chikou span was able to bounce above the price. It made higher highs but failed to break out of the trading range. The Tenkan-sen also crossed above the Kijun-sen, but it was unable to sustain the breakout. In number 4, this seems to be a possible breakout for a trader because the price went above the Kumo. However, it failed to stay above the Kumo. You would find that the Chikou span was not able to break above the trading range. So, Chikou span went back below prices, which is bearish. Now, in this area, we see a Kumo twist. That would be a welcome sign for bulls of LC. We can see that price rallied when the price bars hit the Kumo. However, price was still not able to break above the range. Despite the Kumo twist, we see sentiment going back to bearishness after the Kumo twist. So prices had gone in and out of this Kumo, above and below the Kumo, and the Chikou span had been breaking above and below the prices. Now, because the price is still in a trading range, we should not be trading this using Ichimoku or signals from Ichimoku because Ichimoku is ineffective in this kind of environment. So do not use Ichimoku in a sideways environment. Part 2, trend following, and Ichimoku. Lesson 1. Moving averages. We use the 50-period SMA, or simple moving average, along with Ichimoku levels to determine the areas of strong support and resistance. Simple moving averages are computed as the average of prices over a period of time. Now here's the chart of Ayala Land, or ALI, where we find the 50-period SMA, the pink line. The 50-period SMA is an effective indicator of trend. If price is above the 50 SMA, it is on an uptrend. If price is below the SMA 50, it is on a downtrend. Now notice how prices tend to bounce off the 50 line or the SMA 50 line as support in an uptrend. Price also tends to bounce against the SMA 50 line as resistance in a downtrend. Now, just like simple moving averages, each Ichimoku component is a representation of prices over a period of time. Now again, here's the chart of Ayala Land. Here's the Kijun-sen in number 1. Here's the Tenkan-sen in number 2. You have the Senku-A, number 3. And the Senku-B in number 4. Now these lines are measures of equilibrium. They're computed in different ways. They have different formulas. As such, they also represent supports and resistances. Now, despite their differences, there are points in the chart where Ichimoku components and the simple moving averages fall in close proximity to each other. This chart of Ayala Land includes both the SMA 50 and the Ichimoku components alongside each other. In box 1, we find the Senku-B line. Along with this, we find the SMA 50 line. Since they are located in the same area in this chart, that level becomes a strong resistance. Now, when price was finally able to break above this resistance, it retested that level as the new support. The successful breakout started a new uptrend for Ayala Land. Price consolidated after that initial surge, and in box 2, price made its way towards the Senku-A line. Now, in the Senku-A line in box 2, we also find SMA 50. The price used that area as a bounce-off point for a further uptrend. In box 3, the confluence of SMA 50 and Senku-A as support was broken. This resulted in a strong downtrend. There was a Kuma twist, and at box 4, the confluence of SMA 50 and Senku-A was now a resistance. It continues to be a resistance at box number 5. Once broken, this confluence had become strong support and bounce-off areas for Ayala Land in boxes 6, 7, and 8 when it made a strong uptrend. Now, in this chart of SCC, or Semirara Corporation, we find that the confluence between the Senku-B and SMA 50 in box number 1 served as a strong resistance. However, once price successfully broke above that level, it resulted in a strong uptrend. In box number 2, after a Kuma twist, the Senku-A and the SMA 50 line now served as strong support. every time price makes a correction towards the SMA 50 line, it also makes a correction towards the Senko A line. So these areas have become strong support for SCC and resulted in strong upward move. Now take a look at this chart of SMPH or SM Prime Holdings. We also find the same two lines, the SMA 50 and the Senko B, serving as resistance to prices. Now once price was able to break above that resistance, it became the new support. Every time prices need to consolidate, it uses and references that level. In this area, we find that price broke below that confluence. However, it was able to return back above SMA 50 immediately. So if you find confluences in certain areas in the chart between SMA 50 and the Kumu or the Tenkan-sen and the Kijun-sen, you would find that these serve as strong bounce-off points for prices. Therefore, it's a possible area of entry. If it's a resistance, then it's a possible area of exit. If a strong resistance such as this is broken, you know that it will be followed by a strong uptrend. Now, in our previous Ichimoku lessons, we have been using traditional Japanese candlesticks in our charts. This time, I would like to introduce you to Heikin Ashi candlesticks in lesson 2. Now let's look back and talk about traditional Japanese candlesticks that we have been using in the past. Traditional Japanese candlesticks are popularly used by traders as a signal for trends, reversals, and breakouts. They tell the trader about the price action of a security within a given time frame. They are formed using the open, the high, the low, and the close of a given time period. A candle that opens at the low and closes at the high is bullish and is green. A candle that opens at the high and closes at the low is bearish or red. So an increasing candlestick or a candlestick whose price is increasing is bullish. Candlestick whose price is decreasing is bearish. Now let's take a look at this chart of PNX using traditional Japanese candlesticks. Long green candlesticks show buying pressure, while long red candlesticks show selling pressure. Dojis show possible reversal. Now this chart of PNX shows an uptrend and the sentiment is generally bullish. However, if you are trading the security, it would not have been easy for you to determine the trend because there were many pauses in between the uptrend and there were many conflicting signals and noise given off by the candlesticks. Now, there are also a variety of candlestick patterns. There are 1 candlestick, 2 candlestick, 3 candlestick patterns using traditional Japanese candlesticks. They help you determine bullishness or bearishness of price action. Now let's talk about Heikin Ashi candlesticks. Heikin Ashi candlesticks are a modification of the open, high, low, and close series used by traditional Japanese candlestick charts. The main advantage of Heikin Ashi candlesticks is that it makes it easier to spot the trend. Heikin Ashi is Japanese for average bar. These candlesticks are a weighted version of candlesticks calculated with the following formula. Close equals open plus high plus low plus close divided by 4. High equals the maximum of high, open, or close, whichever is the highest. Low equals the minimum of the low, open, or close, whichever is the lowest. Open is the open of the previous bar plus the close of the previous bar divided by 2. Now there are 5 primary signals of Heikin Ashi candlesticks. Hollow or green candles signify an uptrend. Hollow or green candles with no lower shadows indicate a strong uptrend. Buy and hold these positions. So you see that this candlestick has a wick pointing above. This wick tells you the direction of the trend, which is upward. Now, filled or red candles indicate a downtrend. Filled or red candles with no higher shadows identify a strong downtrend. Sell these positions. As you can see from this candlestick, there's a wick pointing to the bottom. This means a strong trend to the downside. One candle with a small body surrounded by an upper and a lower shadow indicates a trend change. Wait for a confirmation before any action is made. If this candlestick is followed by a bullish green candlestick with a wick on top, then the succeeding trend is an uptrend. If this is followed by a red candlestick with a wick at the bottom, then the succeeding trend is a downtrend. Here's an example of the use of Heikin Ashi candlesticks in the chart of Phoenix Petroleum or PNX. Now, these green boxes contain green candlesticks or a series of green candlesticks with upper wicks which indicate a strong uptrend. Now, since they have no lower shadows, this increases our conviction of a strong uptrend. These are areas where traders must buy or hold their positions. As long as the trend continues, you can still add to your position. So we hold these positions as long as the long upper wicks and long bodies or long green bodies are present. However, once we see that the wicks are forming lower highs, we know that the trend is weakening and we have to be ready for a change in the trend. Now here are the orange boxes. These are areas which contain small bodies with long upper and lower wicks. When we spot this on a chart, we wait for confirmation before any action is made. If it is followed by a green candlestick, then the succeeding direction is up and we buy. If it is followed by a red candlestick, then the succeeding direction is down and that is our sell signal. Now these red boxes contain red candlesticks, and these candlesticks are on a strong trend downward because they contain no upper wicks. Since they contain lower wicks, then we find a strong trend downward. These are areas where we should sell our positions and wait for a reversal before entering a new position. Now, Heikin-Ashi identifies trend much more effectively due to its smoothing ability. Take a look at this first chart of bloom using traditional candlesticks. The candlesticks by themselves are unable to establish the general direction of the market. Price makes an uptrend, and you have no idea whether that uptrend will continue or whether it will form a new downtrend. The series of candlesticks at the top do not often result in a downtrend, and the series of candlesticks that might be bullish at the bottom do not necessarily result in an uptrend. So it's a guessing game for the traders whether this uptrend will continue or whether the downtrend will continue. So the direction is often subject to the personal bias of the trader. It's also very hard to capture the trend because of the various different candlestick formations found inside the trend. Now, here is the chart of bloom using Heikin-Ashi candlesticks. As you can see from the second chart, the directional moves are smoothed out in a way that is absent from the first chart. It is able to present an established trend clearly so as to prevent a trader from getting in and out of a position prematurely. At one glance, you already know what direction the price is going. Because you see a series of green candlesticks, you know it's on an uptrend. You see a series of reds, you know it's on a downtrend. So if you see a series of green candlesticks, you just buy and hold. If you see a series of red candlesticks, just sell the position and wait to enter once again. Now, areas in between those uptrends and downtrends are areas where you find small bodies and long wicks, which are reversal areas or possible reversal areas. Heikin-Ashi is an effective tool because it does not adjust price, but only the way price is displayed. Price is displayed in terms of the open and the close, and it includes the average prices. Heikin-Ashi helps traders stay in the trend longer by strengthening the conviction in the trend. If the price of the current candle is above the average price of the previous candle, then you're in an uptrend. When you are able to present the average pace of price through candlesticks, you can easily see the trend of the trade. If Heikin-Ashi helps you stay in an uptrend longer, then this is a tool that is worthy of using. Now we would like to apply Heikin-Ashi candlesticks to our Ichimoku charts to strengthen our conviction on the direction of the trend. Let's talk about using Heikin-Ashi and Ichimoku together in trend following. So if price is above the Kumo, then you already know that price is on an uptrend. If along with this, you also find a series of Heikin-Ashi candlesticks with no lower wicks, then you have a very strong uptrend. In a strong uptrend, price is above the Kumo and the Heikin-Ashi candlesticks are green with no lower wicks. In a strong downtrend, price is below the Kumo and the Heikin-Ashi candlesticks are red with no upper wicks. In an uptrend, as long as the Heikin-Ashi candlestick agrees with the trend in an Ichimoku chart and there is no wick pointing in the opposite direction of the trend, then technically there is no reason to exit the trade, unless you would simply like to take profits. In our previous lessons, we have identified the conditions for an uptrend using Ichimoku. These are the Kijun-sen crossover, the Tenkan-sen crossover, the Chikou span crossover above prices, the bullish Kumo twist, and the price breakout above the Kumo. Now these signals tell you that it is time to enter the position and go long. You will find the Heikin Ashi candlesticks showing a strong uptrend. Now, once all these conditions have been met, you know that. So once we have entered the trade, we just follow the trend. The uptrend that followed is strong, as evidenced by the bullish Heikin Ashi candlesticks, whose wicks are in the direction of the trend. So the trend is up, and the wicks are pointing upward, and there are no lower wicks. This means that the uptrend is strong. We hold the position as long as price is above the Kumo. If you're a momentum trader, your stops would be the Tenkan-sen or the Kijun-sen line. At this point, we get a signal that the trend is weakening because the closing price is lower than the average and because the body is also smaller. This was followed by small bodies with wicks on both sides. This signals a possible trend change. Now, however, this needs to be confirmed. At this point, we get a signal in the direction of the trend. So the small body with two wicks on each side was followed by a bullish candlestick. Therefore, the succeeding trend would be an uptrend. Now, if you find wicks on both sides of the candle, you will find choppy action and indecisiveness among the bulls and the bears. This is an indication that the trend is weakening because the price is breaking the average price of the prior candle. The set of wicks, when followed by a bullish candlestick, means that the direction is an uptrend. So another strong uptrend followed. With Heikin Ashi, a wick displayed in the direction of the trend signifies the strength of the trend. If the trend is up, the wick should be on top. If the trend is down, the wick should be at the bottom. So again, we have another series of wicks which signal a possible trend change. Now, this next wick told you the trend direction. It had an upper wick on a green candlestick, which tells you that it is in for more uptrend. Then we have a succeeding strong uptrend. Now, all these things happened on top of the Kumo, which shows you that the general trend is also an uptrend. In this part, in the middle of this uptrend, we see a small wick with a small body with upper and lower wicks. This is a pause in the movement. Buyers and sellers are probably consolidating. Price is probably consolidating. And what followed was a series of green candlesticks which showed the general direction of the trend again. Now what followed was a strong downtrend. Notice that there was no reversal candlestick before this downtrend, perhaps because this was a strong move at the open to the downside. So the candlesticks, that's the downside of a Heikin Ashi candlestick. It does not always give you that small body with lower and upper wicks, sometimes in a strong gap down situation at the open, you'll find that this is not present in those reversal areas. However, inside that strong downtrend, we see a possible trend change. However, it was followed by another red candlestick, which continued on its downtrend. Now what follows again is a series of wicks, then uptrends, and all this happened above the Kumo, which adds to our conviction that this is bullish. Heikin Ashi candlesticks and Ichimoku are a perfect combination because they are great indicators of trend. Now in the last two boxes that followed, we see a possible trend change. Not only did price break, not only did price stay above the Senko B line, it also created a small body with long upper and lower wicks. Once it broke above that Kijun-sen and Tenkan-sen line, it went on to more upside, and once it broke above the Kumo, stronger moves happened to the upside. It is important to note that Ichimoku is used to filter out the noise in price action as well. The color and the direction of the Kumo and the relationship of the Ichimoku elements with each other build the bias. Heikin Ashi filters noise further from candle to candle so that traders could focus on the average pace of price and not any single candlestick. Using Ichimoku and Heikin Ashi together help traders stay in the trend longer after Ichimoku signals have provided the entry point. I'd like to show you a trade example. Here is IMI. First, we find our entry point. IMI had already met the conditions for an uptrend. Again, what are these conditions? Kijun-sen crossover, or the price crossover above the Kijun-sen, the Tenkan-sen crossover above the Kijun-sen, the Chikou span crossover above price, Kumo twist, and the Kumo breakout. After these conditions have all been filled, we know that we should enter a long position because we are anticipating an uptrend. So after we have entered the position, we just follow the trend as long as the trend is above the Ichimoku cloud or the Kumo, and as long as we find bullish Heikin Ashi candlesticks, then we know that the trend will continue. This will allow us to hold on to the trend much longer. Of course, there will be consolidations within that trend, but as long as you're able to get in and out of the trend using the trend change candlesticks and are able to buy or sell based on the succeeding candlestick, then you would have been able to ride this position from start to finish. Again, your Tenkan-sen and Kijun-sen will serve as your support lines. You would notice that in a strong uptrend, prices do not visit the Kumo anymore. They only go as far as low as the Kijun-sen and then make a bounce thereafter. In stronger trends, the support is only until the Tenkan-sen. Mostly the IMI had been consolidating above the Tenkan-sen, only with a few periods where it visited the Kijun-sen. So again, in trend change candlesticks, you follow the next candlestick and look at the bias of the next candlestick to know where it will be going. Now, when candlestick hits the Tenkan-sen, it provided the clue that it will bounce because it had a green HA candlestick with the upper wick at the support level. So you know that this will bounce because not only is support at that area, there's also a bullish Heikin Ashi candlestick after that small body with long upper and lower wicks. So Heikin Ashi bullish candlestick at the Tenkan-sen points to more uptrend. So it is bullish. It showed a sign of reversal at an important support level. At this area, the Heikin Ashi candlestick at the Tenkan-sen again points to more uptrend. However, this candlestick shows you the downtrend because there was a small body with long upper and lower wicks. And then it was followed by a break of the long red Heikin Ashi candlestick below the Tenkan-sen. So there are many bullish clues in this area. Not only did price broke below the Tenkan-sen, it also made a long red candlestick with a long lower wick. So this provided us with a clue that price will break down from support. And when price met with the Kijun-sen, the next support level, it again made that long lower wick with the red candlestick. Now this area, the bullish candlestick also points to more uptrend. But currently, at Kijun-sen support, the HA candlestick was still pointing downward, so it was bearish. So you know that that level will break as well. But when we got to the Kumo at the bottom, there was a small body with long upper and lower wicks, which tells us that there will be a succeeding uptrend. So I'd like to show you a trade example using CPM. So we would like to create a trade plan based on the current chart of CPM. This is the current chart of CPM. Price had already bounced off the Kijun-sen and is attempting to break above the Tenkan-sen. It shows a series of small bodies with wicks at the top and the bottom after the downtrend. This provides traders with the possibility of a trend change. So we prepare a trade plan based on this setup. So here's our trade plan. We buy if a green Heikin Ashi candlestick with upper wick is spotted. We buy if the Heikin Ashi candlestick closes above the Tenkan-sen as it is above the Kumo. Now, why are we interested in this security? Here's the case for bullishness. Price is above the Kumo. Price is above the Kijun-sen. The Tenkan-sen is above the Kijun-sen. The Chikou span is above the price action from 26 periods ago. The Kumo ahead of price is bullish and rising. The Heikin Ashi candlestick made a series of small bodies with long upper and lower wicks after a series of bearish red candlesticks. And price closed above the average. Now, we also need to find out what is bearish about the security to avoid us from being too biased. Now, here's the case for bearishness. The price is below the Tenkan-sen, and the Heikin Ashi candlestick still has wicks on both sides and had not yet established direction. So we don't know yet what direction CPM will take because there is no confirmation candle yet. Again, here's the candle. Here is the chart for CPM. CPM is still on an uptrend. So we chose this stock to. So we chose to make a trade plan for this because the security or prices is still on an uptrend. It made a short consolidation downward at the peak It was followed by, after those long red candlesticks, it was followed by a series of trend reversal candlesticks which had small bodies and long upper and lower wicks. Now, while this was happening, the price continues to stay above the Kijun Sen, which means this is still on an uptrend because it had not broken below the Kijun Sen line yet. Now, this is the area where we find the trend reversal candlesticks. Price is still above the Kijun Sen. So this tells us that it's still on an uptrend. And it will only be invalid if price breaks below the Kijun Sen. Now let's talk about bounce plays. The combination of Ichimoku and Heikin Ashi candlesticks could also be used for bounce plays. Bounce plays are short and quick. In a downtrend, we wait for a trend reversal candle followed by a green Heikin Ashi candle with a wick pointing up for a signal to buy. In an uptrend, wait for a trend reversal candle followed by a red Heikin Ashi candle with a wick pointing down for a signal to sell. So let's take a look at the chart of PXP using traditional Japanese candlesticks. PXP's prices had been moving above and below the Kumo. It had not yet established a firm uptrend. Nonetheless, PXP's bounces are profitable due to the huge swings, and traders may want to take advantage of those swings. Now, the candlesticks used in this chart are traditional Japanese candlesticks. You'll find that it is not easy to spot signs of reversal during these periods using these candlesticks because there's a lot of noise with that single candlestick on top and the many gaps in this chart. This was the single candlestick on top. This is noise. These are the many gaps in the PXP chart, which also serve as noise. Now, looking at this chart, it's not easy to see where price might bounce because this is a very volatile security. There are many gaps in between. It succumbs to strong upwards and downward price movements. Now let's take a look at the same chart using Heikin Ashi candlesticks. Do you notice the difference? Using Heikin Ashi candlesticks, you'll find that the trend is clearer. You will more easily spot the uptrends and the downtrends. Here are the uptrends and the downtrends. It's easy to spot the trend because you have a series of red and green candlesticks. So as a trader, it's easy for you to trade using Heikin Ashi candlesticks in this kind of volatile security. Now, possible reversals are signaled by small bodies with long wicks on both sides. Here are those trend reversal candlesticks. Once you see that in an Heikin Ashi chart, you just wait for the succeeding candlestick and then you can buy once it gives you a bullish candlestick after that small body with long upper and lower wicks. There are extreme cases, however, for example, in gap downs. For example, in the same chart as in PNX earlier, price gap down quickly in this area for PXP, so you're caught unaware. So that's a disadvantage of Heikin Ashi in strong gap downs. You think that the trend is going up, but of course these are event-driven activities. These are also Weaknesses of traditional Japanese candlesticks. While the trend may be up, a huge gap down can change the trend all of a sudden. Now, Heikin Ashi candlesticks in combination with Ichimoku give clear signals of trend and reversal that could be used for bounce plays. Now let's talk about Fibonacci retracements. Previously, we talked about X in our earlier Ichimoku classes. We know that prices bounce off certain levels which serve as supports and resistances. But if you have a confluence of factors, for example, the Senkou A and ranges or Fibonacci levels at a certain area, then the probability of a bounce is much higher. Or the probability that price will resist or be supported will be higher at areas where there is also Fibonacci support and resistances. Now these are areas where price bounced. Previously, I also showed you that these areas are also areas where you find Fibonacci levels. If you remember the chart from previous lesson. Now, this next chart shows you that while prices broke below the critical Kijun-sen level in this chart, it was supported by the Fibonacci line or the 50% retracement of Fibonacci. And then it made a tweezer bottom pattern. And then after that long downtrend, a small body with long upper and lower wicks occurred at the same level of Fibonacci. We know that 50% retracement is a support level for Fibonacci. If you find a reversal candlestick at that area with a small body and long upper and lower wicks, and this is followed by a green candlestick, then you are quite certain that this security will give you profits to the upside. It will bounce strongly because it retested the 50% retracement level twice and was able to form a trend reversal candlestick at that area. Now here's your next chart. Again, we find that prices bounced off the 2236 Fibonacci level. Now there was a confluence of supports at that area. These are the following. You have the Fibonacci 23.6% level. You have the Senkou A. You also have SMA 50 and the Tenkan-sen support line at that area. So this warrants a strong buy because there are many supports at that area. So this led to a strong price action after a bounce off that strong area. To add to our conviction, we also find trend reversal candlesticks at that same level. We find a series of small bodies with long upper and lower wicks which are encircled. So we have the level, which is the Fibo and all the different Ichimoku elements coming together to give a strong support at that area, which resulted in a strong bounce. And the Heikin Ashi candlesticks was able to tell us that the bounce was going to happen after it made a trend reversal candlestick and the green candlestick afterwards. Now in this chart, we find the same situation. Price bounced off the 38.2% Fibonacci level. It was also the same area where we find SMA 50 and the Senkou A line. When you find a lot of supports in a particular area and at the same time you find a small bodied Heikin Ashi candlestick with long upper and lower wicks, then you know it's a strong buy because it will give you strong profits afterwards. Because it will give you profits afterwards. So the chances that this will bounce is much higher than if only one Ichimoku element was present in that area. This time you have Fibonacci, SMA 50, Ichimoku, etc. And this was supported by the Heikin Ashi candlestick as well. In this next chart, we see that price also bounced at the 50% area. At this area, what do we find? We find SMA 50 line, we find the Senkou A line, and the 50% Fibonacci area. Now the Heikin-Ashi candlestick before that long green candlestick showed wicks on top and at the bottom. This also shows indecision. However, it shows a weakening of the selling because it already gave us a wick above the small body. Also, this is a strong buy because there are many supporting elements at its bounce. Here's another one. At the 2236 Fibonacci level, in the first candlestick, price was supported by the 236 level. It was able to bounce off the Tenkan-sen and closed above. Was able to close above the 236 level and above the Tenkan-sen level days after. This, along with this bounce, we find a 3 bullish candlesticks with long upper wicks, so we know that the bounce will continue because there is no reversal yet from then. The second circle, we also find support at 236 Fibo level. At the same time, we find the Senkou A line at that area, and there was also Heikin-Ashi candlestick that shows trend reversal with a small body and long upper and lower wicks that was followed by a green candlestick. So this is how you use Fibonacci levels, SMA 50, the Kumo, and other Ichimoku elements along with Heikin-Ashi in order to increase your conviction for a certain trend. Now let's talk about other topics, divergences and Ichimoku. Previously, we talked about how we could apply Ichimoku and divergences at the same time to find reversal signals. In this chart, we find that price is on an uptrend, but the indicator is on a downtrend. So there is a bearish divergence in this chart. Now this chart shows you that price had peaked at this level because there was a bearish divergence. The bearish divergence warned us of a possible change in trend. At this peak, we find a trend change candle. It has a small body and a long upper and lower wick. This candlestick was followed by a bearish Heikin-Ashi candlestick wherein it was a red candlestick with a lower wick. This pointed to a downside. Now, prices indeed went down and then prices bounced up. On the bounce, it retested its previous high, but as it did, it made another bearish divergence. What followed was another candlestick with a small body with long upper and lower wicks, and then a downtrend followed and prices went below the Kumo. That Kumo twist signaled that possible trend change. The Kumo twist signaled the possible change in trend. Now here's another chart. Again, we see an uptrend, but we also see a bearish divergence. There was a trend change candlestick on top, and then there was a downtrend, and this downtrend broke the Kumo to the downside. The downtrend caused prices to break below the SMA 50 and the Senkou A support. And we said that once these two are broken as support, a strong move happens to the downside, which is what happened here. This possible downtrend was also signaled by the bearish Kumo twist. Here's another chart. There's an uptrend here, the bearish divergence here. Then you have a set of reversal candlesticks at this area, or trend change candlesticks. We don't know yet whether the succeeding candle would be green or red. So we have to wait for a signal to know whether it will go up or it will go down. Alright, so today we reviewed the different Ichimoku elements. We also discussed how to use Ichimoku along with Heikin Ashi candlesticks to determine trend, how to use it with moving averages, Fibonacci, and divergences. The main point to remember here is that Ichimoku is an indicator of trend. Therefore, it should not be used in ranging markets. Other tools should only support your bias of an uptrend or a downtrend using the main tool, which is Ichimoku. The other tools, such as Heikin Ashi, let you know whether price is likely to go down. Bearish divergences also tell you that, along with bullish divergences if a bullish reversal is about to happen. So we use these elements all together to increase our conviction of an existing trend or a possible trend reversal. So I'd like to talk to you more about other strategies to be employed with Ichimoku next week. Thank you very much for attending today. Send me a message if you have any questions. Thank you very much and goodbye. Third, a Chico span crossover. Fourth, a Kumo twist. Fifth, a Kumo breakout. So once we've satisfied all these conditions, we are able to enter the position. So we enter here. So notice how prices made a strong uptrend afterwards. Now from here on, your Kijun Sen and Tenkan Sen serve as support levels. Now at this area, now swing traders can take advantage of the rally. So this is the major trend from here on is upward because price satisfied all the conditions for an uptrend. But there are possible reversal points within the major trend that swing traders can take advantage of. For example, in this area, we see a strong uptrend, but we find that in this candlestick, the trend is weakening because the close on this day is lower than that of yesterday's. Not the close, but the wick. You see lower high wicks. The wick today is lower than that of yesterday, suggesting weakening. And then you see the trend reversal candlestick at this area. This tells you that there could be a correction. And this candlestick tells you where the correction is headed, where the direction is headed, which is downward, because we find a red candlestick. While it has lower and upper wicks, which suggests that the downtrend is not that strong, it still suggests weakness in the short term. So if you were a swing trader, you would have taken your profits at this area, and you would wait for another reversal candlestick below in order to re-enter the position. So it resulted in a strong move upwards once again. So each trend change candle should be a warning for the swing trader to change his bias from bullish to bearish and vice versa, depending on the color of the candlestick that follows the trend change candle. A red candle following a trend change candle signals a downtrend. A green candle that follows a trend change candle signals an uptrend. So here's your next trend change candle. We have a series of trend change candles in this area. So what gives us our direction is the